Okay, I want to spend today introducing Chapter 18, the accounting for income taxes, and then this isn't going to take up anywhere near the entire period. So I'm going to briefly introduce, I'm not going to go into a great deal of detail, I'm going to briefly introduce what the new revenue recognition standard that was released in the joint task force between the FASB and the International Accounting Standards Board. So I've got some slides, a PDF slides from an Ernst & Young webinar that they gave on the revenue recognition, and I'm just going to introduce that before I let you go on this bitter, cold day to go enjoy your spring break. All right. So, accounting for income taxes. Income taxes under U.S. GAAP is not, for many instances, going to be the amount that you actually write a check for and send to the IRS. There are a number of reasons for that, and that's why we've got a whole chapter on this. So there are timing differences between financial net income and taxable income. So how many are taking taxation of entities? Just a couple of you? All right. So some of these differences will be familiar, but don't worry about it if you're not taking that course. I'm going to go over them in detail. So the three things that cause differences between financial U.S. GAAP net income and taxable income that is reported in the case of a corporation on an 1120 form to the IRS can be temporary in nature. And we'll talk about, this is really the main focus, is the temporary differences. So just to introduce it, a good example is depreciation. For U.S. GAAP purposes, depreciation can be straight line, can be double declining balance, can be some of the year's digits, can be units of production. For tax purposes, you must use what is known as MACRS, which is Modified Accelerated Cost Recovery System, something like that. It's a prescribed table of percentages that you get to deduct for tax purposes depending upon what the fixed asset is. If it's a building, they classify it as so many years. If it's a car, they classify it as this. If it's a piece of computer equipment, they classify it. And then they tell you how much you're allowed the first year, the second year, the third year, and so forth. And you just multiply that by the tax basis of the asset. Okay? That causes a difference. If you're using straight line, and we'll do an example on that very scenario that I just said. If you're doing straight line depreciation, MACRS is going to allow you to deduct more in the first couple of years than it will in the latter years. Okay? You're still only going to ever deduct for financial and tax purposes the original cost of the asset minus its salvage value. That's still going to be 100% of what you're going to depreciate over the life of the asset, the useful life of the asset. So that's a temporary difference. There are also permanent differences. There are things that in the U.S. tax code they allow you to deduct that we do not allow you to deduct for financial purposes, or we don't require you to accrue for financial purposes, and vice versa. A good example is penalties. You run afoul of the EPA and they fine you. You violate the Foreign Corrupt Practices Act, and the Justice Department initiates an investigation and you get fined. You have to take that fine and put it on your GAAP, U.S. GAAP financial statements. because the users of your financial statements need to know that you've done this. You, however, do not get to deduct for your tax purposes fines paid to the U.S. government. That would be a little counterintuitive. You know, here's the fine, here I want a 35% of it back as a tax deduction. Okay? So that's a permanent difference. Another great example is municipal bonds. Bonds issued by the city of San Antonio, for instance, are not taxable for federal purposes, whether you buy them individually or as a corporation. They give that, Congress has enacted that, tax-free status of municipal bonds in order to allow municipalities to pay less interest. Because if the investor's not getting taxed on it, they don't need to have the same kind of yield that a taxable bond has to pay. All right? So it's giving local municipalities a little bit of a break on the interest expense that they have to put out to fund new schools, new municipality buildings and parking lots and this, that, and the other. All right? So that's a permanent difference. And then the last are operating loss carrybacks and carry forwards. If you've had a profitable business and you've been diligently paying your taxes year in and year out on the profits that you've been making, the taxable income that you've been making, and then one year you, for reasons that are varied, you lose money. You have a loss. U.S. tax law has an odd little anomaly that allows you to take the losses generated in the current year back 2 years and get a tax refund to kind of ease the pain of losing money. So you can take it, and it's elected, you can elect to take it back 2 years, or you can carry it forward, I believe, 20 years. All right?
So in 20 years, you'll be able to get all 20 years.
Assuming that you, whatever it is you lost in the current year, you make enough taxable profit over the next 20 years to offset it. Yeah. Okay? All right, so those are the three types of differences. Temporary differences, and that's the bulk of the chapter. That's what we'll be focusing on in the problems and such when we get back from spring break and we get to reintroduce ourselves, because you guys won't remember any of this. I know that up front. So watch the video maybe Monday morning of spring break, just kind of refresh your mind. It won't be that long, or after you get back. All right, the 16th. Okay, so we've got a bunch of temporary and permanent differences, and then the difference between pre-tax income and taxable income can be offset by a third option, which is the operating loss carrybacks and carry forwards. So, temporary differences, timing. These fall under either a deferred tax liability, in other words, you're deducting more now than you will be able to deduct in the future. That's the depreciation. All right? And I'll go over this. Or it generates a deferred tax asset. In other words, you're paying taxes now and you'll be able to deduct it in the future. And there are reasons that I'll talk in great detail. I've got 4 slides that describe all of this. Because it can be a timing difference based on revenue, generating a liability, a timing difference on revenue generating an asset, or it can be a timing difference on an expense, doing one of both. So there are 4 options, and we'll talk about these. So let's talk about the liability first, revenue differences. Installment sales. Installment sales are recognized when you first make the sale for financial purposes. Another good example is long-term contracts. We just got finished doing that. Long-term contracts, construction companies get to report, for U.S. GAAP purposes, percentage of completion as you complete a long-term, multi-year contract. For tax purposes, however, it's completed contract. The IRS does not want to know about your project, your building, your highway, your stadium. They don't want to know about it until you're finished. So all of that we were doing on Tuesday, where all of a sudden it generated a loss and we had to go back 2 years and reclaim all the gross profit that we had on that project. The IRS wants none of that. They only want to know how much did you make or lose on the project when it's finally done. All right? Unrealized holding gains. We talked about that in this course at the very beginning, chapter 12, I believe. If you've got a trading security, you know a trading security, management's intent when they bought the security is to hold on to it for short-term gain. Because of that, any unrealized increase in or decrease in the stock price at year end gets reported on the income statement. Once again, perfectly acceptable for U.S. financial GAAP. The IRS wants none of that either. They only want you to report the gain and loss when you actually sell it. Okay? So all of this is you're generating income now, but you're not going to pay the taxes until sometime in the future. So that's a deferred tax liability. All right? Does that make sense to everyone before I move on to the second type of liability, which is the expense side? All right. The expense side, we talked about the difference between straight line and makers. That's the most common timing difference that generates a liability. In the early years, we deduct more for tax purposes under the makers system because makers is loosely based upon 200% double declining balance with a half-year convention. All right? So that's what makers is based on. If you're using straight line for financial purposes, you're going to deduct more in the early years under makers than straight line. But in the latter years, it's going to turn around. So you've been creating a liability by crediting this deferred tax liability year in and year out for the early years, and then in the latter years, you start debiting it to wipe it out. And I'll do an example on that very scenario here in a second, okay? And we'll do problems. Interest. Now, this is for those of you that took Intermediate 1 last fall. You know that if you're self-constructing an asset, you're building your own warehouse, you're building your own offices, you could accrue and capitalize a portion of the interest expense on the project. Is those of you that took Intermediate 1 remember all this briefly? All right. You're not allowed to do that for tax purposes. The IRS doesn't allow you. They require that you deduct it, which is what you want to do because you want to minimize taxable income. Think the mindset. You want to minimize, you want taxable income as low as possible because you actually have to outlay taxes to the IRS. What do you want financial income to be? As high as possible, because that's what your shareholders and your investors and your creditors and your banker wants. All right? So there's this whole struggle, you know, good angel, bad angel, sitting on the CFO's shoulder when it comes to this stuff. So you want to deduct the interest, but you, for financial purposes, you want to take it. So there's a good example where the tax basis of the building is going to be lower than the financial basis because the financial basis, the book value of the building, includes the interest expense, and it doesn't on the others. Prepaid expenses are a good one too. You go out and you spend 6 months to lease a building. You move into it on December the 1st. Well, for financial purposes, you only took 1 month of rent expense on that 6 months that you paid in advance. For tax purposes, you get to deduct all of it. You paid it, you get to deduct it, okay? The opposite occurs. So that's all liabilities that are created through expenses. What about assets? Assets are where you're paying the taxes up front for revenue that you're going to take for financial purposes down the road. Here's the opposite. You're now the landlord, not the lessor, the lessee. All right? Not the tenant. You're the landlord. You're renting facilities, and someone gives you 6 months of rent up front. For those of you that are interested in being tax accountants, and early, because that's what I was when I first started out, 4 years was enough to make my head explode, and I got out. But it was a good 4 years. Couldn't tell you, I could barely do my own taxes now, so don't ask me those questions. The tax books of the world balance. If you think of every taxpayer, the world balances to zero. Because what somebody takes as a deduction, somebody else has to take as income. And this is that rule. All right? You're creating a tax asset by claiming for tax purposes all 6 months of rent that you collected. Okay? The world's tax books balance. Okay? So that's that. Gains on sales and leasebacks, I'm not going to talk about. We won't do an example. That's an increasingly rare transaction in my mind. But anyway. Financial purposes, you spread them out over all the entire life of the lease. But for tax purposes, they're taxed on the day that you sell it. But we're not going to even worry about that. And then the last type of temporary difference is an asset. This is paying taxes up front for an expense that is going to occur down the road. All right? Warranty costs, bad debt. Bad debt's a great one. You know, for financial purposes, we accrue a debit to bad debt expense, and then we create a contra asset account, the allowance for doubtful accounts. You calculate it either based upon a percentage of sales, a percentage of all the receivables that are outstanding, or doing an analysis of the aged accounts receivable. So those are the common methods. And we put this into the financial in order to match the revenues being generated with the eventual bad debt of customers not paying you. Okay? Don't get to do that for tax purposes. You don't get to speculate on your tax return that somebody may not pay you sometime down the road. You can only deduct a bad debt for tax purposes after you have exhausted with a specific customer all collection efforts. All right? The IRS is very stringent, which is even when I was doing taxes for a living. Cash tax deductions, you know, somebody actually spending money in order to, those never make any sense because you're only getting your marginal tax bracket. For a corporation, 35%. You only get 35 cents on the dollar back. So the joke at KPMG back in the day is if all you want is a cash deduction, just write me a check. I'll give you a bad debt because I'm not paying you back. So, and that's a bad debt. Well, bad debts are only deductible when they actually incur. This we just got finished doing, compensatory share option plans. For financial purposes, remember we estimated how much the compensation was based upon in the last midterm, $4.99 per share option times the however many executives times the 15,000 shares that they got. Well, we accrue that throughout the 3-year period. For tax purposes, we only get to take that compensation expense when they exercise the option. Okay? So, the tax deduction is not only allowed when the employees exercise the share options. Okay. All right, so that's the 4 types of differences. We have liabilities generated by both revenues and expenses, and we have assets, once again, generated by revenues and expenses. All right, so marginal tax rate is what we'll use, and that's what will give us. Right now, we've got a graduated rate, just like you as individuals have a graduated rate, so it depends on how much taxable income you generate, how much tax you pay. So whatever that top rate is, and 35% is right now where corporations max out. All right? So for the most part, it's 35%. But the problem is always going to give us that. All right. So in each one of these problems, we're going to take pre-tax income, we're going to add or subtract the temporary differences and the permanent differences. We're going to permanently remove the permanent differences, and then we're going to calculate either deferred tax liabilities or deferred tax assets on those 4 types of changes that are temporary in nature that I just got finished talking about. Once we have taxable income, we multiply that by the marginal rate, and we come up with income taxes payable. That's where we're going to start on each and every problem that we do. How much do we actually need to pay the IRS? So you take pre-tax income, do whatever adds and subtracts that you need to do to come up with taxable income. Multiply that by the tax rates, the statutory tax rates, and then that gives us income taxes payable. And then we'll calculate individually either the deferred tax assets or the deferred tax liabilities. So liabilities increase income tax expense, and assets decrease it. And that's it. That's all we're trying to do. Extremely straightforward. Okay? All right. So the basic entities, we buy a truck or buy an asset of some sort. The track company buys an asset for $6,000. For financial purposes, we're going to straight line with 0 residual value over 4 years, $1,500 a year in depreciation expense for U.S. GAAP. For makers purposes, it's classified as a 3-year asset. Now, just to make it a little confusing, because remember I told you that the IRS allows you a half-year convention. So if you buy it, even if you buy it on New Year's Eve, you get a half year's worth of tax deduction, all right? Which people do on occasion buy things on New Year's Eve. I've done it myself for tax purposes. I bought me a new sports car one year on New Year's Eve. It was a lot of fun. I was a tax accountant, and that was a business. I had to go drive around. So anyway, notwithstanding. So the tables, by the way, are on page 1132 back in the property, plant, and equipment chapter. So that's where the makers tables are. So with taxable income of $7,500 after the depreciation with a tax rate in the first year of 30%. So for the timing difference, we have $1,500 in straight line depreciation for GAAP purposes, and we have $2,000 because the maker's table for year 1 under a 3-year asset is 33 1/3%. So that's $2,000. That generates a difference of $500. Multiply the $500 times the 30% tax rate, marginal tax rate, you get a $150 difference which is a deferred tax liability, because you're deducting $2,000 off of your 2013 tax return, but you're only expensing $1,500 for book purposes. So that's a liability. Eventually you're going to pay that money to the IRS, because it's only a $6,000 asset any way you count it. Yes?
So you're only doing expenses for 2 years?
No, we'll do all 4 years here in a second. This is year one. So right now, well, they don't have the entry. Right now, the entry is a credit to a deferred tax liability that is lowering the payable to calculate the expense. So it's lowering the expense in the current year. All right? So, what about year 2, 3, and 4? Well, in year 2, the percentage is 44.45% from the maker's table. That's $2,667. Now we've got $1,067, or $1,167 of difference in the second year, multiplied by the 30%, increase the liability a little bit more. In 2015, it turns around. Now the accelerated method is generating less of a tax deduction than the straight line is accruing the expense. Because the third year, the maker's table only has 14.81%. So that's a difference of $611 multiplied by the 30% tax rate. And now we're going to be debiting that liability, whittling it away.
Is this deferred?
The deferred tax liability, yes. Okay? All right, so here's the tables. And unfortunately with this table, they don't include the 2013. Because remember in 2013, we had a difference of $500 and a difference of $150. So in the first year, we credited the deferred tax liability $150. In the second year, we credited it $350. Now for that one asset, that deferred tax liability has a balance of $500 because we had $150 in that first year. In 2015, we then debited that liability because the tax deduction was only $889, whereas straight line is always $1,500. So that now we're going to debit it $183. That's going to lower that overall tax liability down to a balance of $317. And at the end of the 4 years, the liability is zero, and the timing difference is gone. Does this make sense? Yes? All right, this one is what happens if Congress changes the rates, which they love to do. Then what happens? Same example, only now in 2014 they're expecting, rather than a 30%, we had 30% in 2013, remember, we still had that 150. Now we're going to go from 35% down to 30% and then back to 33% and back to 30%. Well, in that case, we're always going to calculate the deferred tax liability using the current rate, marginal tax rate, in that year, whatever is applicable. So what happens at the end? Now it doesn't go to zero. It's got a balance left over of $111. Well, in that case, we take that $111 to the income tax in the final year. And this should say 16, not 13. So we're just adding it, we're wiping it out and adding it to the expense in the last year of the asset. That's all. Okay? And I'll do an example of that come Tuesday. So those were all temporary differences. What happens with permanent differences? Permanent differences do not generate a deferred tax asset or a deferred tax liability. They're always different. So just to do that, we'll talk about, there's three types of permanent differences. Non-taxable revenues, this is that municipal revenue on bonds, municipal interest paid on bonds. It's never taxable. Non-deductible, that's the penalties. If the EPA fines you, you don't get to deduct that for tax purposes. And then there are allowable tax deductions, and there's some odd ones in the petroleum industry where the Congress incentivizes people to go out and explore for oil, and so they allow them tax deductions that are not financial deductions. They're non-cash in nature. You don't spend any money, it's like a gift. It really is. And so there are some of those odd little deals. But we'll mainly focus on non-taxable revenues and non-deductible expenses when we do problems. So here's an example. Let's see. We've got $75,500 in pre-tax U.S. income. We have interest revenue of $7,500 from municipal bonds. Never going to be taxed. We have a gross profit of $10,000 on an installment sale. This is not taxable for, this is a temporary. It's in our finances. It's in our financial income, but it is not taxable until the customer actually pays us the installment. Okay? We take kind of a cash basis on this. And then lastly, we have rent revenue on a 3-year rental contract that was paid in advance. So all 3 years, $3,000 per year has been collected. This is taxable. This is not. Okay? So these two are, this is generating a tax liability. We'll pay the taxes. This is generating a deferred asset because we're paying we have the income now, but we're going to pay the taxes later. And then this is we're paying all the taxes up front. Okay, so this is an asset, that's a liability. All right, so here it is. So we have a deferred tax liability of $300 for the installment sale difference, and then it's always going to be 30%. So we take let me go to that one. We're going to remove the permanent difference, the $7,500, and then we're going to, the excess of the gross profit from the installment sale. So of the $10,000 that we recognize for financial purposes, they actually paid us $2,000 during the year in cash. All right? And then we remove the rent out of the financial income. Okay? Because we only got to, we add in the rent that for tax purposes. Because they paid us $9,000, only $3,000 of it have we earned. All right? So we subtract the $8,000, add the $6,000, and that gives us taxable income of $6,600. Multiply that times our 30% tax rate, that gives us taxes payable. That's where we'll start. Multiply this $6,000 by 30%, that generates our deferred tax asset, a debit. Multiply the $8,000 times the 30%, that creates the deferred tax liability for a credit. Add the credit, subtract the debit, and that gives us our expense. And that's the way it works. All right, last subject before we talk about revenue one last time. Carry forwards and carrybacks. The statutory requirement is that if we elect, and it is an election, you're under no obligation legally to take it back and get a refund. You don't have to do that. You can take it forward if you want. And people do that if the tax rate is expected to be higher in future years. All right? If you do carry it back, you have to go back to the earliest of the 2 years. So if you generated an operating loss for 2014 this past December and decide to carry it back, you have to go back and offset all your taxable income from 2012 first, and then anything that's left over you can take to 2013. Right? Otherwise, you can just elect to carry it forward for as many as 20 years. So 2 years back, 20 years forward. So we had a loss of $9,000. In 2011, 2 years ago, when the tax rate was only 25%, we made $40,000 in taxable income. And then in 2012, when the tax rate was 30%, we made $70,000. So this is why you're not allowed to cherry pick the carryback. Because otherwise, they would want to take the 90 and offset all of the 70 first, because you paid more taxes on it. So the refund is going to be $25,000. You go back and you offset all of the 40, of which you paid 25% on for $10,000, and then that leaves you 50 to offset against the 2012 taxable income of $70,000. So that $25,000 is a debit to income tax refund receivable, because you're actually going to get that cash back when you file that amended return to do the operating loss carryback. And then we have, this is God bless you, it's a contra expense in essence. So rather than income tax expense, where you come down, in this case, to pre-tax or pre-tax loss from operations, then you would then add the income tax benefit from operating loss carryback. So there's your income statement. You have pre-tax operating loss, $90,000, less the income tax benefit from operating loss carryback of $25,000. Your net loss is $65,000. So it's a negative expense. Yes, sir.
Can you go back one slide?
Sure.
Why is the 2012 $50,000 instead of $70,000?
Well, because we only have a $90,000 loss in total. We generated an operating loss of $90,000. So we only have $90,000 to carry. Yeah.
Okay, I get it.
So 40 of it we're going to eat up in 2011. That leaves us 50. So we don't get to offset. That was what I was talking about. Even though it was a higher rate, we don't get to offset all of the 70. Okay? Now, granted, if you turned around in 2014 and generated another loss, you could go back into 2012 and offset the remaining 20. But that's not sustainable. Corporations don't really generate losses for long. Okay? So that's the income tax, accounting for income tax. All right. I'm going to take 10 minutes tops and talk about revenue recognition. All right. As I mentioned last week sometime, last year, it was the end of May, they issued a new standard. This is a global standard. So the international community follows the same exact rules as we do here in the U.S., which is virtually unheard of. It covers all contracts with customers, as well as sales of non-financial assets. So if you sell a building, a truck, whatever, as well as patents or trademarks, if you sell a non-financial asset, this standard applies. There are 5 steps. And at first, it looks extremely easy. You're going to identify whether or not you have a contract. This can be a written contract or an oral contract. If it's oral in nature, it depends on the municipality in which you entered the contract, because there are places around the world that will not legally accept an oral contract. You cannot do a handshake deal. All right? So local law where you enter into this agreement applies. Then identify the performance obligation in the contract. What is it you're agreeing to do? That's not always simple. And one of the examples, we're in the standard, and the example that this is all from Ernst & Young. See, it says EY down here. All right. One of the examples they use, and I'm going to flip to that real easy because it'll show you what performance obligations are. Then you determine the price overall for this contract and then allocate the entire price to the individual performance obligations. Because oftentimes it's not just one, and I'll show you here, software installation is the example that they use, and I'll show you what that is. And then as you complete the individual obligations, then and only then do you get to take the revenue. Okay? So that's the 5-step model that the world is getting ready to adopt this year. All right? We go to the example. Right. This is contract price. Contract price always sounds so obvious, right? What about in this instance? You're building a manufacturing facility on a customer's piece of land. You've agreed to do that for $10 million. While you're there constructing this, the customer comes to you and goes, listen, I need a storage facility to store either the raw materials or the finished goods that is coming out of this manufacturing plant. Will you do it? And you agree, okay, I'll do it for an extra $1 million. Right? That's a modification to the existing contract with a separate performance, the storage facility. What if, under your normal pricing model, if you had just been asked to do the storage facility, you weren't already there doing the manufacturing plant, your normal price for a building such as that would have been $1.1 million, not $1 million. So now what's the price? Well, the example, and this is one of the examples, I think EY, it was example number 3 in the standard, this very scenario. Because you had already in place the equipment, the labor, they were already there getting ready to build it, this is a reasonable price allocation. Okay? Because the big question is that $100,000 discount only applicable to the storage facility, or are now you doing a price discount on the original manufacturing? So who takes the, so anyway, that's a good one. Here's the arrangement for performance obligations. You're going to install a software package for, well, it doesn't say. It's made up of 3 separate items. The license for the software, the installation of the software during the first 30 days, up to 100 hours. So you're going to provide a technician and an advisory group that will help install this software and for 100 hours. And then lastly, Over the next 3 years, you will maintain that software, including fixing any bugs for free, plus make unspecified modifications. So if your customer wants something changed, you're willing to do that on that software. All right? So those are the 3 performance obligations. So you go through, is each of this being distinct? Do they ever sell the software as just the license without the installation or the modifications? Do they sell those professional services? In other words, do they go out to other customers and modify their software without being under this umbrella contract? And then are the upgrades done separately? This is the installation. The professional services is the installations. All right? So are these 3 separate and distinct uses? And if they are, then they can be separately priced and separately recognized. Okay? The CPA exam in your future is going to talk about this. Not what I've been talking about. This is it. And the EY, if you want to watch it, it's an hour and a half. I can put I'll put these slides up and the link to the EY webinar if you want to listen. It's 4 partners from their New York office talking about this. These are very high-level, intelligent people, and they walk through it in great detail over 90 minutes. So if you want to watch that, it's always free to register for these. You just put your name and an email address in there, and they give you access to play it on demand. And that's with all of their stuff, okay? All of the big 4 have these webinars that are free. So, as well as there's a consulting group called Providia that's got a whole series on revenue recognition too. Because this is the hot topic for the last 2 years. Everybody's panicking because you got to start doing it at the end of the year. And this is major, major changes. Because of the international, this is one of the very first major standard in the United States that is principles-based, not rules-based. I think you've heard me state in this class before. U.S. GAAP is 35,000 pages of rules, many of which are industry-specific. They've got an entire standard on the software industry revenue recognition under U.S. GAAP that is now being chucked. All right? The international is principles-based. They give you some general guidelines, those 5 steps. You know? Identify the contract, identify the performance obligation, identify the price. Allocate the price to the performance obligations. Recognize the revenue when you complete that obligation. That's the international way of doing things. Okay? But we now, in the United States, are going to have to make some assumptions. We have to go through this kind of decision tree on contract modifications, on the original contract. What is separate and distinct? And that, I fear, may lead to some issues. We'll see. Remember, 10 years ago, we promised the world that we were going to scrap U.S. GAAP and go with the IFRS. We promised. Then we reneged on that promise, and I don't think we're ever going to adopt the international standards. And that's because of their being principles-based, where we need rules in the United States. We have a very, very active litigation industry in the United States, and shareholder litigation is a bit of a cottage industry here, where people sue for not doing what you said you were going to do. Okay? All right.